If someone offered you $80,000 as a W-2 employee and someone else offered you $80,000 as a 1099 contractor, most people would look at those two numbers and think the offers are equal. Same dollar amount, same headline number, same life on paper. But there's a reason one of those people is going to end up with thousands more in their pocket by the end of the year, and it has nothing to do with how hard they work. Quick note before we get into it. This video is for education only. It is not tax, legal, or financial advice. Your actual numbers depend on your income, state, filing status, deductions, and personal situation. So speak with a qualified professional before making major decisions. Now let's get into the real math. Here's what nobody explains when you're comparing these two offers. A W-2 salary and a 1099 payment are not the same type of money. They look the same on paper, but they're built completely differently underneath. And if you compare them the wrong way, which most people do, you can accept a contractor offer that actually leaves you worse off than the job you turned down. The biggest mistake is comparing gross pay to gross pay. People see $80,000 on both offers and treat them as equal starting points. They are not. A W-2 salary is employment income. A 1099 payment is contractor revenue, usually paid without automatic tax withholding. The contractor is generally responsible for calculating and paying their own income tax and self-employment tax. That one difference changes every number that follows. And keep this in mind as we go through the numbers. The biggest hidden layer is not just taxes. There is another part of the 1099 math that quietly destroys contractor income, and most people do not see it until it is too late. But before we get there, we need to start with something most people ignore completely: benefits. Benefits. Real, dollar-valued benefits. When you take a W-2 job, the salary is just the number you see on the surface. Underneath it, there's often a whole structure of support that has actual monetary value. Employer health insurance support can be worth thousands of dollars per year, depending on the plan. Then there may be retirement matching, paid time off, paid sick leave, workers' compensation coverage, and unemployment insurance eligibility, depending on the job. That's a significant amount of value sitting underneath the salary number that most people never bother to calculate. Now, not every W-2 job has all of that. Some have weak benefits. Some have almost nothing beyond the paycheck. But when those benefits exist, they're part of what you're actually being paid. They're just hidden. So when you move to 1099 work, the question you have to ask yourself is simple: who pays for all of that now? Because most 1099 contractors do not receive employee-style benefits like health insurance, paid time off, or employer retirement matching from the clients they work with. They usually have to secure those benefits themselves. That means if you were getting $80,000 as a W-2 employee with a decent benefits package, and you switched to $80,000 as a contractor, you haven't maintained your financial position. You've taken a quiet pay cut while the number on the invoice stayed the same. This is why freelancers sometimes feel confused. They make more revenue than they made as an employee, but they still feel financially stressed. They say, "I made more this year, so why do I feel behind?" The answer is usually that they made more revenue, but they didn't keep more money. And that brings us to the part that surprises people the most: taxes. And specifically, the one tax that almost nobody accounts for when they first go 1099. For many people moving from W-2 to 1099 income, self-employment tax is one of the biggest financial surprises. As an employee, you pay 7.65% towards Social Security and Medicare, and your employer matches that amount on their end. You never see that matching half because it was never part of your paycheck to begin with. As a 1099 contractor, both halves land on you. Let that sit for a second. As a W-2 employee, your employer is quietly covering half of your Social Security and Medicare taxes every single paycheck. You never see it, you never think about it, but it's happening. The moment you go 1099, that employer half doesn't disappear. It just becomes your responsibility. Self-employment tax is generally 15.3%, but it is generally calculated on 92.35% of net earnings from self-employment, not simply on every dollar of gross revenue. If you have $400 or more in net earnings from self-employment, you generally must file Schedule SE and pay self-employment tax, even if you also receive Social Security benefits. And this is on top of your regular federal and state income taxes. Self-employment tax is separate from income tax. You calculate and pay both. So your total tax burden on self-employment income is the self-employment tax plus your marginal income tax rate. Let's put real numbers on this so it's not abstract. Assume a contractor has $100,000 in net self-employment earnings before the self-employment tax calculation. That is not the same as a $100,000 W-2 salary. Using the simplified self-employment tax calculation, $100,000 x 92.35% x 15% comes to roughly $1,430 in self-employment tax before income tax enters the picture. The salaried employee pays roughly $7,650 in employee FICA, and the employer pays another $7,650 that the employee never sees. So on the same $100,000, the contractor is paying meaningfully more in employment taxes before income tax even enters the picture. And going back to our $80,000 example, a self-employed person with $80,000 in net earnings can face a higher employment tax responsibility than a W-2 employee with the same headline income, because the employer-side FICA support is no longer sitting with an employer. Now, there is some relief built in. There is some relief. You can generally deduct the employer equivalent portion of your self-employment tax when calculating adjusted gross income. But that is a deduction, not a dollar-for-dollar credit. That helps, but it doesn't erase the gap. It softens it. There's also the quarterly payment system, which trips up a lot of new contractors. Since taxes are a pay-as-you-go deal in the United States, waiting until the annual tax filing deadline to pay your self-employment tax may mean incurring late payment penalties. You may need to make quarterly estimated tax payments if you expect to owe at least $1,000 after subtracting withholding and refundable credits, unless you meet one of the IRS safe harbor rules. Miss those dates, and the consequence isn't just a delayed bill, it's underpayment penalties stacked on top of the tax itself, even if you pay every cent by the April filing deadline. The IRS can penalize underpayment during the year, not just whether you eventually pay by the filing deadline. So what does a new contractor actually do? A simple and commonly recommended approach. A common starting point is to set aside 25% to 30% of each payment, but your real number may be higher or lower depending on your income, state, deductions, and filing status. That may be enough for some people, but not everyone. State taxes, deductions, other income, filing status, and household income can change the number fast, so treat 25% to 30% as a starting point, not a guarantee. The moment a client payment hits your account, move that percentage out immediately. Treat it like it was never yours because a significant portion of it isn't. This is the mindset shift that separates contractors who feel in control from contractors who get blindsided in April. A W-2 paycheck arrives already processed. The taxes have been handled before the money reaches you. A 1099 payment arrives raw. As a 1099 contractor, you usually receive payment with no automatic withholding. You calculate and send your own taxes, including self-employment tax, which is generally calculated using the 15.3% rate on 92.35% of net self-employment earnings through quarterly estimated payments to the IRS. You are the payroll department, you are the tax department, and if you forget that, the money that felt like freedom becomes a bill you weren't ready for. Now here's where we get to the thing I mentioned at the start. The layer almost nobody accounts for. It's not the tax rate, it's not the benefits gap, it's the hourly rate trap, and it quietly destroys the math for thousands of contractors every single year. When most people think about going freelance, they do a simple calculation. They say, I want to make $80,000 a year. A full-time work year is roughly 2,000 hours, so I need to charge $40 an hour. Sounds logical, but for a contractor, that math is broken. And here's why. A W-2 employee gets paid for hours that aren't billable. They get paid during meetings, during training, during slow periods, during certain vacation days. Their salary covers all of it, but a 1099 contractor usually only gets paid when a client is actually paying an invoice. Everything else, the sales calls, the client emails, the revisions, the invoicing, the bookkeeping, the tax planning, the chasing late payments, the gaps between projects, all of that time comes out of your pocket. So if you work 2,000 hours a year, but only 1,400 of those hours are actually billable client work, and you're charging $40 an hour, you haven't made $80,000. You've made $56,000 before taxes and expenses. That's a massive difference from what the math looked like on paper. Your freelance rate is not your wage. Your freelance rate is your business survival number. It has to cover everything the business needs to stay alive. Taxes, expenses, benefits, unpaid time, admin work, risk, slow months, and late payments. If you price without accounting for those things, you can look busy, have clients, have invoices, have revenue, and still be financially fragile underneath it all. So how do you compare these two offers properly? You need a better formula. A rough shortcut is to start by pricing a contractor offer meaningfully above the W-2 salary number, often in the range of 30% to 50% higher, depending on benefits, taxes, expenses, risk, and unpaid time. For example, if a W-2 job pays $100,000 and includes meaningful benefits, a contractor offer may need to land closer to $130,000, $140,000, or even higher before the math starts to feel comparable. That is not a perfect formula, but it gives you the right instinct. The contractor number usually has to be higher than the salary number to be truly comparable. For employers, the real cost of a W-2 employee can run well above salary once payroll taxes, benefits, insurance, workers' comp, and administrative costs are included. A 1099 contractor at $75,000 may cost the business much closer to the contract amount because many employee-related costs are no longer on the employer side. That's the appeal. The client saves money by hiring you as a contractor. But if you don't price to reflect what you're now absorbing, you're the one subsidizing that savings. You're giving them the benefit of your independence while you carry the burden. And risk has a price too. If a company can end your contract quickly, that's risk. If you have no paid sick leave and you get sick for 2 weeks, that's lost revenue. If a client is late on payment, your cash flow takes the hit. If there's a gap between clients, nobody covers that time but you. Risk is not just a feeling, it's a real financial cost that needs to be built into your rate. Now, there are real advantages to 1099 work when it's priced correctly. Self-employment tax is generally calculated on net earnings, so legitimate business expenses can reduce the profit that self-employment tax is based on. But an expense is still money leaving your business. A home office deduction, business mileage, software subscriptions, professional development, equipment. When properly deductible, these expenses can reduce business profit, which may affect both income tax and self-employment tax calculations. That is one advantage contractors may have over W-2 employees, because business expenses can reduce business profit before the tax calculation. 1099 workers may be able to offset part of the tax gap with legitimate Schedule C deductions, such as business mileage, equipment, supplies, software, professional development, and a qualifying home office. Some 1099 workers may also qualify for the qualified business income deduction, which can be worth up to 20% of qualified business income if they meet the rules. But this deduction has limits, so do not assume you automatically get the full amount. And for higher earners, there's even more strategy available. Self-employed workers may also have access to retirement tools like a solo 401k or SEP IRA, which can help build retirement savings and may reduce current year taxable income depending on how they are used. For 2026, the solo 401k elective deferral limit is $2,400, plus possible catch-up contributions if you qualify. Self-employed workers may also be able to make an employer contribution, but the calculation is more technical for sole proprietors. So this is where a tax professional or retirement plan provider matters. That's a powerful tool for building wealth while reducing what you owe. That can create planning flexibility that some W-2 employees may not have, especially if their employer plan is limited. So 1099 work isn't bad. Underpriced 1099 work is bad. There's a meaningful difference when you price correctly, save correctly, track your expenses, separate your business and personal money, plan for quarterly taxes, and build a cash buffer. Contractor work can be a genuinely strong financial path. But if you accept a contractor rate that barely matches an employee's salary, while also losing benefits, paid time off, stability, and employer support, You're not gaining freedom. You're gaining more responsibility without enough pay to cover it. If you've been thinking about making the jump to 1099 work, or you're already there and wondering why the math feels off, drop a comment below and tell me where you're at. I read these, and it genuinely helps me know what to cover next. And if this kind of real financial breakdown is useful to you, hit the like button so more freelancers and contractors can find it. Because the next video breaks down how much 1099 workers should set aside for taxes from every payment, so April does not become a financial emergency. Here's the bottom line. Before you compare two offers, stop looking at the top line number. Ask the real questions. Who withholds the taxes? Who pays for health insurance? Who funds the retirement account? Who pays when you're sick? Who covers the slow months? Who buys the equipment? Who handles bookkeeping, invoicing, tax payments, and admin? Who carries the risk? When you ask those questions, the comparison becomes completely clear. A W-2 salary is a compensation package. A 1099 payment is business revenue. They are different machines, and you cannot judge them by the same number. W-2 versus 1099 is not just a tax form difference. It changes how money reaches you, what you must cover yourself, and whether April feels routine or becomes a financial emergency. So the next time someone hands you a 1099 offer, don't just look at the check. Do the real math. Taxes, benefits, expenses, unpaid time, risk. Then ask yourself honestly, is this contractor rate actually paying me more? Or does it just look bigger because nobody has taken anything out yet? That question alone can save you from a bad deal, help you negotiate a better one, and stop you from confusing gross revenue with actual financial freedom. Because there's a difference between 1099 freedom and 1099 panic. And the only thing separating them is whether you did the math before you said yes. And if you want to avoid that panic, watch the next video on how much 1099 workers should set aside for taxes from every payment. Because once the money hits your account, the next mistake is treating all of it like it belongs to you.